Over the past couple weeks, I've got a number of people over on Patreon asking what investments out there pay both high dividends but are also more tax efficient. Because a lot of what I talk about on this channel pays dividends that are classified as ordinary income, which just means the dividends they pay are taxed similarly to what you'd receive from working a typical job. And although no one has ever turned down a pay increase at their job because it would result in more taxes needing to be paid, it just makes sense that a number of people who are building an income stream with dividends would want more tax efficiency. So today we're going to take a look at some various options that exist for people who want big dividends with tax savings. Before we get started, I want to show you how you can find out the tax treatment of a dividend-paying investment because it's pretty clear that a lot of people don't seem to know how to do this. When it comes to dividends, they're classified in one of several different ways depending on the investment type. With individual stocks, the dividends they pay are either qualified or non-qualified, and sometimes non-qualified dividends are referred to as ordinary income. To find out the tax treatment of a stock, you can go to Dividend.com and type in the ticker symbol. Scroll down to payout history and it'll show you if the dividends are qualified or not. However, this is not going to be accurate for business development companies or any other pooled investments like ETFs. With ETFs and BDCs, this can be trickier. Both of these investment types hold various different investments inside of them. So ETFs can hold stocks that pay both qualified and non-qualified dividends, and BDCs hold debt, CLOs, preferred, and common equity. Some of these investments publish their 1099s on their websites, or they can say in their prospectus what they expect their dividends to be in terms of tax treatment. Some of them will make a press release on the tax treatment of their dividends for some reason, and for others, it's incredibly hard to locate the information. I'd recommend Googling what the tax treatment is for a holding if you can't find it, like SCHD tax treatment. Then finally, with closed-end funds, it's pretty straightforward. They report their distributions as investment income, short-term capital gains, long-term capital gains, and return of capital. You can locate a CEF's dividend treatment on cefconnect.com and typing in a ticker symbol. Click on distributions and scroll down, and you can see the source of each distribution the fund pays. Long-term capital gains and return of capital are the most tax-efficient distributions, but ROC can be a double-edged sword. If ROC distributions aren't from an option strategy, then it's usually the result of the fund distributing the capital already invested inside of it. So if a closed-end fund is using a significant amount of ROC, then that's going to be a big red flag. But this is not going to be the case if the fund uses an option strategy. ETFs and closed-end funds are allowed to report a large chunk of their dividends as ROC if they were generated using options. A number of covered call funds, for example, have a lot of ROC in their distributions, and it does not mean the fund is eating itself. Also, each fund will sometimes publish the dividend tax treatment on their website. For those that are very tax conscious, I would say stick with CEFs that report a good amount of long-term capital gains. But you can see that every month the percentage of each type of dividend changes. Some months can be all long-term capital gains and others can have very little or none at all. It can be unpredictable from month to month, so you'll need to keep that in mind. Okay, so now that we know how to find the dividend tax treatment of a holding, let's look at some different options that exist that pay more tax-efficient distributions. Let's start by looking at covered call funds. There's a lot of different options that exist, and some of them use different strategies than others. A lot of CC funds pay tax-advantaged dividends, but you'll need to do your research on each ETF you're considering. If you're looking for high income with tax efficiency, I'd recommend any of the high income funds by NEOS. Because their ETFs are actively managed, they seek to take advantage of tax loss harvesting opportunities while using index options for its options overlay strategy. The option contracts are classified as Section 1256 contracts, and as a result, they're subject to lower 60/40 tax rates. Right now I currently hold SPYI and QQQI, and I've been really pleased with the results so far. There's also IWMI if you're a fan of the Russell 2000, but I'm personally not a fan of this particular index. There's other covered call funds out there that exist that pay distributions that are better taxed. A higher risk covered call fund that exists that provides tax savings is FEPI, the Rexfang and Innovation Equity Premium Income ETF. Just like the NEOS funds, this ETF uses a lot of ROC with its dividends because of its option strategy. It is a lot more volatile than similar funds like QQQI, but it's another option that exists for more aggressive investors. If you're looking for high income with lower taxes, then covered call funds are likely going to be your highest yielding option. What you'll also realize though is that there's not a lot of options available in terms of investments that offer higher yields and significant growth. REITs, master limited partnerships, and a handful of BDCs can offer high yields with good growth, but it's more difficult to find high-yielding holdings that'll lower your dividend tax bill unless you're looking for qualified individual stocks. Let's turn our attention to closed-end funds, which can sometimes offer good growth and high yields plus diversification. One of my favorite CEFs, which is UTG, has a history of paying a lot of long-term capital gains in their distributions. In 2024, long-term capital gains and qualified dividends paid by its equity holdings made up a very large percentage of its distributions. This fund's holdings are mostly utility stocks, which usually pay qualified dividends, making them more tax efficient. UTG currently offers a yield close to 7% and pays monthly dividends. Another closed-end fund that pays a good amount of tax-advantaged distributions is UTF, the Cohen & Steers Infrastructure Fund. Although it is less tax-efficient than UTG, I'd say around half of its monthly distributions come from long-term capital gains, but it can vary a lot more. This fund holds companies that are very big on infrastructure, which also includes a lot of utility companies, which is again a sector that pays qualified dividends usually. The company BlackRock offers a good lineup of closed-end funds that pay more tax-efficient distributions. They offer funds that hold investments in specific sectors, and the managers will use a combination of a covered call strategy as well as sell shares of the holdings inside the fund to cover the monthly distributions. They are a little different than just a regular covered call ETF in that the fund managers seek to provide a consistent distribution every month. One of their most popular CEFs is BST, their Science and Technology Trust Fund. It holds a lot of popular tech stocks and pays a consistent monthly distribution. So if you're big on tech and you want income, this is going to be one of those ways to do it. You can see a lot of the sources of their distributions are more tax advantaged according to CEFconnect.com. There's also their Health Sciences Fund, BME, their Enhanced Dividend Achievers Fund, BDJ, and their Enhanced International Dividend Trust, BGY. It's a little inconvenient. You'll have to go back and forth between BlackRock's website and CEF Connect to compare the tax treatment of their monthly payments. Another high-yielding investment type that comes with tax savings would be some master limited partnership funds. These can really be efficient in two ways. First, with MLP ETFs, you don't receive a K-1 tax form, but instead a 1099. So that's an extra tax form that you don't have to worry about filing at the end of the year. But also, some of the dividends paid by these ETFs can also be qualified and return of capital depending on the strategy they use. This is really going to be on a case-by-case basis, so I can't say that all MLP ETFs are this efficient. I haven't done enough research yet on all the major MLP ETFs that currently exist. But my favorite MLP ETF, AMLP, says that part of their distributions are classified as qualified and return of capital. I wasn't able to locate a breakdown of every dividend payment type, but this is coming straight from their fact sheet. So I don't really know what percentage of their dividends are qualified. They're also IRA and 401k eligible, unlike investing in MLPs individually. So if you think about it, these ETFs can be some of the most tax-efficient investments compared to buying these companies individually. So that's going to be a look at some investments that are more appealing in a non-retirement account if you're more tax-averse. As a disclaimer, I'm not a tax professional, and I'd suggest speaking with an expert if you want more advice. And of course, this is also going to depend on where you live and your local tax laws. Let me know your thoughts in the comments if you hold any of these, or if you know of any other good high-yielding investments with better tax savings. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.